Hi, and welcome to Symax Fintech Weekly Market Insight. First thing is to apologise about my voice and that. Suffering from a bit of a cold. Try to get through it okay. Hopefully, it won't impact the content. So, as usual, we start off with a disclaimer. So, trading involves the potential risk of loss of capital and is not suitable for everyone, but hopefully it is for you. Uh, when it comes to leverage, just be careful because you can lose substantially more than your initial investment. The views, opinions, everything that's included in these webinars and YouTube, etc., everything that we provide basically is just purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And before you make that decision, you should carefully consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, you should only risk capital you are prepared, but more importantly, that you can afford to lose. Make sure you don't risk too much of your capital. And if you've got any doubts whatsoever, seek independent financial advice before you start risking your capital. Okay, so highlights of last week. So US economy, it's just remaining so strong with demand. You know, they pumped trillions into it over COVID, so it's understandable. But PPI 7.4% and core 6.2%, which were higher than expected. So that did surprise a few people, and of course it wasn't so good for the markets. Michigan sentiment though was much higher than expected. Again, just demonstrates the confidence in the US economy at the moment. And then, of course, jobless claims is they are rising slowly, and just keep an eye on that. Some of these job offers are going to disappear and such like, but at the end of the day, their economy is probably still the strongest out there. And the Democrats won the final seat, giving them a 51-49 majority in the Senate. Apart from that, PMIs were pretty much in line in Europe, although higher in the US, understandably. And when we look at the EU, the economy is still weaker, retail sales negative. However, GDP surprised on the upside. It was a little bit better than expected. All eyes on China again at the moment. So China's economy, it's still struggling. Exports were worse than expected, PPI lower, but CPI higher, and I'll cover that on the macro outlook. The stimulus just hasn't been working. They've still got problems with property and just in general, especially with all the lockdowns, of course. So now they've started to ease their COVID zero policy, and that's despite the record number of cases. Again, I'll cover that in the macro outlook. Australia raised rates this time only by 0.25%, 25 basis points to 3.1%. And Japan GDP came in better than expected. They're pretty much the only country with negative rates still. So have they got it right and the rest of us got it wrong? But I don't think so. Oil remains volatile. It's got negative and positive impactors in play, so it's difficult to know which way that's going to go. It's one of my main contracts for trading, but to be honest with you, the last week or so, I've avoided it as much as possible and traded some other products. Gold remains steady over 1800. Stocks are still reacting to the data. And I just still think that investors perhaps are just a little bit too confident. And also the dollar weakened, which is usual for December. But, again, just my personal view, but I just think it may be getting close to oversold for the moment. Now, this week, we have a massive data coming out. plus the last central bank meetings of the year for the US, Europe, and also the UK. So in the US, as you can see, there's a variety of data, but all eyes will be on the FOMC meeting on Wednesday, where expectations are for a 50 basis point increase. The rate increases are going to drop down, but I still see there being more of them, especially when you look at this inflationary data coming up. In the UK, again, there's plenty of data, but Bank of England's rate decision, again, I'm just expecting another 50 basis points there at the end of the year. The central banks need that little bit of time just to see how the impact on consumers and on the economy, and it takes time for that to feed in. And in the EU, there's some data out, not too much, but then again, Thursday's ECB rate decision, that's probably not so easy to predict. Again, I still think it's going to be 50 basis points, but there are some looking for 75 basis points. And then we've got German ZEW, which tends to see the markets move on that in the mornings. And there is also data out from Japan, Australia, and China. When it comes to China, just look at those house prices again, because that's an area that's really been impacting them. And house prices are starting to impact everywhere at the moment as well. Just because of obviously all these rate hikes. So going to now move on to the macro outlook. Inflation, it's just not dropping as the central banks hoped that it would. And to be honest, it could take years to get back to 2%. The problem's always been that most of the inflation is sort of really with supply issues. And it's, unfortunately, the central banks have got no control over that. All they can do, as usual, is trying to continue to lower demand by putting the rates up. And I still believe that they're going to need to push economies into recession to speed that up to lower inflation. Of course, a key issue, I think, at the moment is that companies are holding on to any savings rather than passing them on to the consumer. If you look at China's PPI, CPI that came out, it demonstrates that last week. PPI was lower, but CPI was higher. It's just maybe it's greed. Maybe they're just trying to take as much as they can before the recessions hit. And also, because of that, we're seeing company profit margins remain the best for over a decade. Now, stagflation is likely in some countries, and just remember that is inflation, but without any growth. You may see stagflation before recession. In China, despite COVID cases at record levels, they have now reversed their policy. They're testing less. They're allowing for self-isolation now. So they're easing all of these very strict rules that they've had in place for so long. But don't be fooled when they declare that there's less COVID cases. That's really misleading. COVID cases are going to continue to increase because they're relaxing the rules. They're just not going to be reported because there's less testing. As I mentioned earlier, the stimulus just really hasn't worked. So this is their only option that they've got left, really. Now, here, this is sort of going to, well, it could go either way. So we could see an improvement in supply chains, which becomes a little bit deflationary. However, it could also give inflation another boost just because demand increases. When we look at what happened everywhere else where the lockdowns ended, we all went on a buying spree, and that may be the same for China. Okay, they haven't been locked down so long, but that may not sort of make much difference. Just the excitement of being released might be enough for them to start increasing demand again. And of course, when we look at Russia-Ukraine, the war continues there, with Ukraine continuing to retake lost ground. That sort of pushed Russia into targeting their utilities, their power, their water, to just sort of try and recover, put a lot more pressure onto Ukraine's infrastructure. And of course, Putin has been sort of mentioning the nuclear option again. Uh, Obviously, nobody wants that to happen, but you never know. Uh, and then, when we look at sort of energy prices have been capped now in the EU to buy Russian oil at $60. Uh, Plus, the US is now allowing Venezuela to export some of its oil after years of sanctions. And of course, the risk of recession again. So, all of those have the potential to be negative for oil prices. Uh, But on the other side of that, OPEC could decide to cut the quotas at their next meeting. And of course, if China's lockdowns do really end, or ease at least, then, that should also increase demand. However, I'd have to say there that, China is more likely to buy their oil from Russia, one, because it's discounted, and two, just because of the relationship. And I think I'm right. It was planned for the end of this year. So if it's on track, then also what we're going to see is that the Russia-China pipeline that goes through Siberia should be ready. And if that, if it's working and all that, the big question then is, does Russia really need the EU to sell its oil or to sell its gas to? Okay, so moving on for food inflation, yeah, again, that remains high, it's sticky. Again, I just can't help but feel that it's just profiteering. The same as oil companies, they've had record profits. I just see that's happening for the food industry and the supermarkets. The only argument that they can have is increased wages, I would say. Uh, energy prices, electricity prices and all that have dropped back down again. Okay, they're not like where they were years ago, but they're down, and they're probably reasonably priced at the moment, shall we say? But part of it, I think, also is psychological. We're told inflation is high. We can see it in the data, uh, and therefore we as consumers we just accept that. Uh, which is probably a little bit wrong. We should start to be a little bit more uh, particular what we're buying and where we're buying it from, and actually shop around. It is almost just a brainwashing. But yeah, obviously prices are higher, but should they remain as high as they are when you see some of these raw material costs coming down? Okay, also keep an eye on EU temperatures. November was really mild, but December the temperatures is dropping fast, and that's going to increase demand. That could push gas prices back up, which again will add to inflation. And it could also, if that does happen, weaken the pound and the euro. Storage has been high, especially as there hasn't been that much demand because of the higher than average temperatures. But that, people are going to start to use more for sure now, December, January time moving forward. So will the storage be sufficient, or is it going to cause sort of the blackouts? Uh, domestic and for industry, because that is going to impact the economies again, and it's also going to impact consumers. There remains that lack of workers. It's keeping wages high, although we are seeing more companies trim staff. Uh, the thing is, many will be sort of probably reluctant to let too many of their staff go because they've struggled so hard to find them in the first place. And of course, once the central bank meetings are out of the way this coming week, I would say, next week and the week after until the new year really becomes for the needy and greedy, which means if you don't need to trade, then don't. And the reason I say that is because the volumes drop off, and of course, what happens then is the volatility increases, and you're likely to get stopped out more if your stops are sort of tight to even reasonable because of that. So just beware going forward with that.